morning and thanks so much for tuning in. You're watching Trade Talk on BP Prime. My name is Alex Matthew. Now, as things stand, it's a positive handover from overseas, with the US markets ending higher and most of the Asian markets trading higher as well. But then there are a lot of other factors to take into account as we look at the start of trade here in India. First and foremost, that has to do with earnings and the earnings of the largest IT company, Tata Consultancy Services. To break that down and to understand what this means for the rest of the IT pack as well, with Infosys reporting its numbers in just a short while later today, in fact. I'm joined by Mahantesh Sabarad, an independent expert. Mahantesh, thank you so much as always for taking the time. Of course, if I look at just key numbers, you have the revenues that have missed estimates, but the PAT numbers come in ahead of expectations, and that's on account of a better than expected margin performance. But then there's a lot more in the details. What is your initial take on the numbers, and then we'll delve a little deeper?
So the initial take is that the revenue numbers are quite tepid, and it does point to the fact that somewhere the execution is slipping for them. While they may have achieved a better margin, that's you will notice that has come because the external consultant fees has been reduced, or basically outsourced work has considerably reduced, whereas their own employee cost has gone up. So there's some a bit of arithmetic to be done here that tells us that the efficiency seems to have, while outwardly seems to have improved, the execution is still lacking.
Okay. What can you say about the TCV? Because you're seeing $11.2 billion during the quarter, which is not something to complain too much about if you look at the number per se, because of the growth year on year and sequentially, Mahantesh. But then the question really is about execution. So, how do you balance the two? On the one hand, they're getting deals, but on the other hand, it seems that they're not executing as you pointed out.
So deal wins are something which we have been seeing that most of these IT companies have been getting it on an elevated basis, and it's not TCS alone which is getting larger deal wins. Most of the Indian IT companies are able to muster in or gather more deal wins as we progress ahead. That's because I think over a period of time they have changed their capabilities, they have adapted to the new digital era. There is a lot of cloud-related work that is now happening, which is coming forth. And most of the Indian IT companies are able to grab a significant pie of that new kind of software development activity. That said, while the deal wins are indeed strong, and that's why you see the book-to-bill ratio improving vastly, there is also an inherent, problem there, because when the big book-to-bill ratio rises, it tells you that somewhere the execution is also faltering. And you can see it also in the form of employee headcount. It has actually sequentially fallen. Even the previous quarter one, the net headcount rise was just about 523, if I'm right. So that tells us that their overall employee base is not really growing, and therefore there seems to be an execution-related problem.
Okay, let's talk about that the employee base in just a bit. But then, based on what we've seen in terms of the key numbers, and based on the expectation, I think a lot of analysts have pointed to the fact that we don't expect a V-shaped recovery in operations in this current financial year. And then looking forward already into next financial year, Mahantesh, are you also in that group of people that are looking forward to either the fourth quarter or, in fact, next financial year? And then, from that perspective, how do you then justify that 27 times earnings multiple that we're seeing, or the valuation multiple that we're seeing at this juncture? Is it too costly?
So, I do also belong to the camp that says that the recovery is going to happen in the next fiscal year. Probably quarter 3 and quarter 4 will be subdued quarters for TCS. But having said that, when you look at from a valuation perspective, many a times, there is a growth premium that gets attached to IT companies. Now, this growth premium comes from the fact that they have large deal wins in the pipeline. The execution may be tepid right now, but hopefully it should recover in the next fiscal year. And therefore, when you attach a growth premium, you will typically find the valuations a bit on the higher side. That said, we also have here a company which rewards its shareholders quite handsomely. Dividend payout is one mechanism, and they also resort to a buyback kind of mechanism. Their payouts are like 100%, sometimes even more. And that tells you that from a shareholder's perspective, they don't mind giving that growth premium so long as there is some significant uptick in the cash generation and the cash payout.
Okay, so what you're saying essentially is that it's not just the earnings that can be attributed to the price as it stands right now. It's also the impact of regular buybacks that the company has done. And speaking of, there has been an interim dividend of 9 rupees announced in this quarter as well, and a 17,000 crore buyback. We were, of course, discussing the mathematics of it based on that 25% of net worth number, and it was a little higher than that 17,000 crore number, but it's not insignificant, Mandesh.
So, I would, as an investor, prefer that you would not have a buyback made, because buyback, unlike a dividend payout, is not doesn't reach everyone, each investor, and therefore it is sometimes doesn't reward all the shareholders on an equal footing. Uh, Therefore, I would be happy that they reduce the buyback amount and raise the dividend amount for all shareholders to partake in the cash generation that the company does. So yes, you're right that the earlier calculations suggested that the buyback amount or outlay by TCS would be larger than the $2 billion, or roughly 17,000 odd crores that they're talking about. One would have expected it a bit more, but so be it. Right now, at least we have a situation where there is also a dividend payout being exercised.
Okay. Last point on TCS, then you've said, effectively you've said, even though you didn't say it in so many words, that the valuation multiple is justified. What would you say in terms of the headwinds going forward, though? Because they're not out of the woods. Seemingly, those pressures in terms of execution and the skeptical customer seems to be continuing and will likely continue till we see all of these headwinds globally. So, do you think that things will get worse before they get better, and will that pose a challenge to the valuation?
So, firstly, there are headwinds. You will notice that BFSI has been showing quite rapid growth for now several quarters. That is the main headwind that all IT companies are facing, including TCS. But having said that, I had already mentioned that there are new capabilities that are coming in, particularly on the cloud side and now increasingly AI side. So hopefully they will have a sufficient talent pool joining in later on for them to tackle any headwinds related to the BFSI sector. Having said that, if I look at the global macro picture right now, one thing can be said is that the US economy is actually growing stronger relative to what most experts would have predicted. And we have seen inflation taming. We are seeing rates a little elevated. That is the Fed's interest rates a little elevated. But since inflation is getting tamed, I think we will have a surge in growth happening in US. And if I'm right, the recent IMF forecast also alluded to the fact that US economy is recovering quite fast. That said, most IT companies have a large exposure to the US economy, and therefore a stronger economic growth will mean that they will have better deal wins, and then execution may be a problem right now, but they should be able to tackle it, like I said, in the next fiscal year.
Okay, growth story is intact in the long term. Infosys, I think a lot of people look forward to because not only, of course, because of its bellwether status, but also because it provides an outlook for the rest of the financial year as well. What specifically are you looking for, Mahantesh, in the results and in the outlook?
So Infosys, if you notice, in the previous quarter had already given a very low outlook for the year, and therefore any incremental change for the better will be lapped up by the investors. So when you are looking at a 4 to 6% kind of growth rate, if there is just a small hint in terms of the growth rate being even 50 bips better should infuse or enthuse the investors to latch on to the investor stock, the Infosys stock. From a relative valuation perspective, relative to TCS, Infosys has suffered a bit, and I guess we more than looking at what is the actual outcome of the result, people would be looking at the guidance for the remaining year, as you have mentioned, and Infosys's guidance is many a times quite accurate.
Would you be able to quantify that to say that what kind of an uptick in the guidance would aid sentiment? And on the other end, if there is a decline, and what are the possibilities of that decline, Mahantesh? Because you had Accenture not too long back indicate that the rest of the year is not going to be, or rather for them, the year to August is not going to be as it was expected.
So, like I said, any 50 bips incremental guidance change for the better would really help or aid sentiments. And we have also seen this execution problem with Infosys. If you remember, their December quarter numbers were, and the subsequent quarter there after that were very disappointing. That pointed out to the fact that their execution, they also had a large order book and good deal wins, but execution was becoming a bit of a problem. Unlike TCS, their execution troubles began a bit earlier, and therefore I hope that they would have tackled the execution related issues better than TCS, and would be therefore looking at therefore, I'm looking at greater chances of an upgrade coming in from them for their outlook.
Okay, final word on these two counters because they're the ones in focus. And with what you know about TCS, based on valuations as they stand right now, and if there is a bit of a dip, would you suggest that a buy on dip strategy is appropriate for Tata Consultancy Services? And how should you approach Infosys?
So let's look at it this way. Now, TCS has a wider investor base, unlike a few years ago. And therefore, I would reckon that most of the investors would have TCS as one of the core holdings within their portfolio, and therefore, it's a portfolio strategy that one should follow. One should remain invested, not only just remain invested in TCS, perhaps take equal to a little slight overweight stance in the portfolio as far as TCS is concerned, and generally participate in the buyback as well. So what will happen is, from a portfolio perspective, when you participate in the buyback, there are chances that some of those shares will get bought back, and therefore you need to replenish that from your portfolio perspective to bring it to equal weight once again.
That point, and that's a 15% upside to yesterday's closing price, and nothing to sneeze at. Mahantesh, thank you so much for joining in and for giving us that perspective. As always, insightful conversation.
Thank you, Alex.
All right, viewers. So we've discussed Tata Consultancy Services, we've discussed Infosys and what to look forward to, but specifically with Tata Consultancy Services, there is a conversation about whether valuations are stretched. Mahantesh certainly seems to think that that is not the case. But then the jury is still up. We'll have to see how it opens. For now, take a look at what the management said at its press conference just last week.
Essentially, clients want to invest in newer technologies. So technology adoption is very high. And given the macroeconomic uncertainty, there is also a lot of request towards cost optimization projects. So we are able to sign new projects. And the projects that we sign, we continue to execute them and they yield the revenue as planned. But in any given quarter, there will always be some amount of degrowth. Essentially, some projects will be complete, they come to a natural end, and some projects will get downsized. So, if the degrowth is much stronger, or usually in a regular good growth quarter, there will be less of degrowth and more of new addition coming in. So, net, you see a lot of growth. But what's happening now is that we are not fully compensating for the degrowth, which is more normal process, but we are not fully compensating because clients are also optimizing or pausing some of the ongoing projects, and so there's some deferral happening. So that's the reason why you see, while the TCV is still strong, the revenue growth, it's not reflecting in the revenue growth.
Ramp-ups, I wouldn't say they are slower. I think, all the new projects that we are starting, as Kriti explained, right, those ramp-ups are according to the plans that we have put in place, right? But as he explained that, any quarter, for example, for TCS, there will be projects which will get completed. In this quarter also, we have 2 large transformation engagements we delivered successfully, and they got completed, right? So to that extent, the revenue from those projects will be sharply lower in this quarter. So the revenue pull that happens from new ramp-ups, new projects that we have signed is according to plan, right? So
what is that plan now for the ramp-up of the other deals?
It's according to what we committed to the project, and it's a project by project we go through. But I don't see any variations per se that we see now typically when we execute large projects, right?
Continue to focus on earnings then. We've got a list of stocks to talk about, not as large, of course, as Tata Consultancy Services. So there's the likes of Delta Corp as well as Signature Global, SAMI and Zaggle. We've got Varsha joining in to give you some perspective on these, and then we'll take a few other stocks in the news as well. Morning, Varsha, what are you picking up?
Good morning, Alex. So few companies that have came out with their results. So first we have Delta Corp, where the revenues were flat at 270 crores, followed by EBITDA, which was down 0.26% at 100 crores. Now margins were at 36%, while Delta Corp's net profit for the second quarter rose marginally as the company saw its expenses rise compared with the same period last year. Then we have Signature Global, which posted its Q1 FY24 results, where the revenues were down 69%, followed by EBITDA loss of 16 crore versus EBITDA profit of 25 crore last year. Then we have net loss of rupees 7 crore versus net profit of 3 crore. Also, company posted its performance summary for H1 FY24, where the company posted best ever H1 FY24 pre-sales of rupees 1,851 crore, which was up 37% year on year. And the collections grew 64% at rupees 1,327 crore in H1. Then we have SAMI Hotels, which came out with results of Q1 FY24, where revenues were up 12%, while EBITDA was down 13% at 45 crore. Also, there was net loss of 83 crore versus net loss of 100 crore last year, and company has reduced its net debt from 28 crore to 18 crore through the utilization of IPO funds. Also, company anticipates significant drop in its quarterly finance cost by 57%. Then we have Zaggle, prepaid ocean services, where revenues were down 36% and EBITDA was down 55% at 7 crore versus 18 crore last year, and margins were at 6.7%. Now, company has guided revenue growth of in the range of 40 to 50%. Also, there was the ESOP expenses which have been laid down of rupees 20 crore. So adjusted EBITDA margin before ESOP expense would be 11 to 13%.
All right. So that's on the earnings front, but also there's a lot more in terms of stocks in news that we have to talk about, and that's quite a large list. What can you tell us?
So yeah, a couple of companies that one should watch out for is Adani Enterprises, where it has raised 700 crores through the issue of non-convertible debentures. Now, the amount has been raised after allotment of 70,000 secured unlisted redeemable NCDs with a face value of 1 lakh each on a private placement basis. Earlier this month, Abu Dhabi-based IHC Capital Holding has raised its stake in Adani Enterprises to over 5%. Then we have JSW Steel, where it has emerged as a preferred bidder for Jaisinghpura North Block iron ore mine in Karnataka. Now, the highest offer price by the company to become a preferred bidder is 150% of the value of the mineral dispatch. Also, the projected iron ore resource is 17.66 metric million tons. Then we have Cipla, where the wholly owned subsidiary of the company in Invagen, which is in US, has received the EIR, that is Establishment Inspection Report from the US FDA. Now, what is EIR? It just means the closure of inspection that was taking place. Then we have Vedanta, where India Ratings and Research has downgraded its ratings for the long-term bank facilities and debt instruments. Now, the ratings have been downgraded to AA minus from AA. India Rating and Research has placed these ratings on ratings watch with negative implications, while reaffirming the ratings on the short-term debt instruments of the company. The instruments of the company were at A plus, and it's placing these ratings on the rating watch with negative implications. Then we have RVNL, which has emerged as the lowest bidder for supply, installation, testing, and commissioning of tunnel communication system in Assam, and the order is worth rupees 28 crore for a period of 1 year. Then we have EMS, where the company has awarded a contract of rupees 270 crores, out of which value of capex is 260, while the value of operation and maintenance work is almost 10 crore. Then lastly, we have an update on Plaza Wires, where the shares will be listed on the stock exchange today, and the issue price is 54 apiece. Now, the 71 crore IPO was subscribed 160 times on its final day. Bids were led by non-institutional investors at 388 times, and retail investors at 374 times, while institutional investors at 42 times.
Okay, Valsa, thanks so much for bringing us those details. And that brings us to the end of this edition of Trade Talk. But before we go, let me tell you about an exclusive introduction that we have lined up on BP Prime, and that is to the management of Tata Consultancy Services. The man himself, Kriti Kritivasan, will be speaking to us exclusively at 10:30 a.m. And that will be live on all of our social media platforms, as well as on the website bpprime.com. So don't forget to check it out. That brings us to the end of this edition of Trade Talk. Thanks so much for watching. This is BP Prime.